All right, thanks everyone for listening in, and welcome to the final panel of the afternoon. It will be a fireside chat with Arjun Sethi, who is the co-CEO of Kraken, and moderating is our own co-founder and CEO, Josh Frank.
Hey, can everyone hear me? Thank you guys all. I know it's been a long day. I know some of you guys have been sitting, for 8 hours or so. Rumor has it this might be the best chat of the day, though. So, thank you guys all for joining, and thank you for coming here and coming out for this event. So, we're going to go right into it. We're going to cover a bunch of, a ton of different ground, from M&A to the IPO market to equities and a bunch of other things. But why don't we get started with the fact that, you recently stepped into this position, I think it was October of last year, kind of at a major inflection point, both for Kraken, but for the industry as a whole. And so what's your overarching vision for Kraken today? But then also, what do you want Kraken to become over the next 3 to 5 years?
Yeah, so I think I'm pretty philosophical in the way in which I think about what happens in financial services and fintech. And so if you were listening to the last panel, they were talking about where things are going to go. And I actually think, like, if you just look at the foundation of where we are now, is we're trying to figure out what collateral moves into crypto. And what I mean by that is real-world assets, tokenized equities, meme coins, meme stocks, et cetera, et cetera. And as this moving more into the crypto ecosystem and plumbing, what are all the tools and services and systems that you use? So Kraken, obviously, one of the first exchanges to promote not just Bitcoin but the next altcoins that came in, Ethereum, et cetera. I think that's how you should think about what Kraken looks like today and continually moving forward. And so we've launched tokenized stocks, not just on our platform, but in the DeFi ecosystem. We've partnered with a bunch of other exchanges. We're providing liquidity. Liquidity is coming to us, et cetera, et cetera. But I think what's more important is that what does Kraken become from here, and how do we use that liquidity and exchange layer to be able to build a new set of products that might be in traditional finance, conversions of what we call traditional financial products.
So, the next thing I kind of want to move into is acquisitions. And you guys have been one of the most aggressive players in the M&A space in crypto. I mean, I think, one example of that is the, recent acquisition of NinjaTrader for $1.5 billion. And so would love to hear about your kind of overarching M&A strategy. Are you guys guided by product gaps, regulatory coverage, product expansion? Like, what's really driving that strategy as a whole?
So we've always acquired companies from a regulatory footprint. So today, Kraken operates in roughly 180 jurisdictions. We're regulated, now obviously in Europe, in Australia, in Canada, TBD in the US with market structure bill. But all going in the right direction. I think what's more important is that we think about M&A in a couple of different directions. One is regulatory footprint, if needed. We haven't really needed that much, so you can think of licensing. Then there is tuck-ins, talent, which everyone sort of thinks about. Then there's where I'd say, do we have an ability to move into an ecosystem much faster, thinking about our rails, our tech, and our distribution for another product that's out there. So you saw that with NinjaTrader, which is okay. We're going to move into the convergence of traditional commodities, and futures on the commodities. Like we're now technically one of CME's largest partners, which is great if you think about like the percentage of revenue that we bring in for them and for us. And when you think about where they are today, and again, I go back to the crypto rails that you have moving forward and where that collateral moves. It's all about moving how people sort of think about trading, savings, yields, etc. So I think things are happening much faster than people realize, but at the same time, they're also happening much slower than they realize. So when people think about real-world assets, we're not really thinking about acquiring too much in that direction right now because there's a lot of regulatory headwinds there. But when we think about assets moving into crypto plumbing or tokenization in some ways, either we're going to move forward and do it ourselves or figure out ways in which to partner. And that's actually where M&A comes into a bigger play.
And so kind of, touching on some of the points you hit, but how do you think Kraken can sustainably differentiate as the lines blur between crypto exchanges, brokerages, and fintech apps?
So I think where we got lucky, actually, really early on, is that when people got into crypto, they were either an exchange for serving like institutional style clients, or they moved into retail, right? So like let's take Binance for instance, or even Coinbase. What they built was a wrapper and then an exchange in some sense, and so they weren't sort of technology forward first, and that helped them in the beginning, which is like let's get the average everyday person on there, consumer, prosumer, however you want to define it. What's happened in the ecosystem now is that everyone's competing for the same customer. And our approach has been that, again, we got lucky in that we focused on professional traders, which is essentially a movement over the last 25, 30 years. And but it's been kind of under the radar, right? Ninja trader, professional traders, you never would have thought about them. What we do, professional traders. So Kraken Pro, the exchange, the trade engine, is catered to that professional trader wherever they are in the world. And so it's a smaller set of people, but it's a larger set of capital. Now, when I have them, they're recurring. They trade on the volatility up, they trade on the volatility down, and they don't churn as heavy as what you'd see in other, what I'd say, consumer products. So when we think about financial products, I'm thinking about serving that customer base. And now that I serve them, they're able to help me promote other types of products that we want. So what have we gotten into now? We've gotten into payments. We've gotten into remittances. We're doing savings and yield products for average everyday customers. But we offer all those products for free, right? So we're not charging a spread. We're not trying to make money along the way. We just basically say, okay, great. Now that we've got an exchange, we have more flow, we've got liquidity, we can offer a lot of these services for free. So kind of think, Google and YouTube, that's kind of how we think about all the type of financial products that we have and then what we can serve out there to keep the base cost at zero.
And I think that's a fair point, on the prosumer, pro trader side and how you guys have approached that. But one of the other things that we're seeing, and obviously seeing some of that in the crowd today, is a convergence of TradFi and crypto from an institutional perspective. And so, you have an interesting vantage point just with all of the, the clients that you guys have, I'm sure, all the market makers, a lot of the takers as well on the institutional side. Who do you think is more likely to win? Is it the crypto firms kind of like, learning TradFi and leaning into these DAT deals and stuff like that? Or is it the TradFi firms adapting to crypto and starting to, trade tokens and do things like that?
I think it's going to be a combination of both. It's multiplicative. So let's take someone like Citadel, right? They've got their, construction of what they want to do and how they want to approach every market. I think the segmentation of these folks matter more than anything else. As people talk about crypto as if it's like one small area, but like, what is crypto? Crypto today is already, a specific type of spread trades. It's FX trades already. Now you have the meme coins. You've got the Bitcoin, ETH. You've got those pairs, and so on and so forth. Like millions of things that we're going to start thinking about moving forward. And the long tail is just getting larger and larger, and the head is getting larger and larger at the same time. So when you start talking about like tokenized equities, issuance of new real-world assets, I think again what's more important is when that collateral from traditional folks moves over to, let's call it, global liquidity systems, then you're able to start thinking about, okay, great, if I have one unified set of platforms, this doesn't mean just Kraken, it just means crypto liquidity and unified collateral systems, is that you're able to start moving things in a non-fragmented way. And I think that's where people kind of, I think that's where they miss the forest from the trees, is essentially, now when I'm thinking about risk management, I can move in and out of positions within seconds, microseconds, whereas today, it can actually take minutes to hours to weeks, depending on which systems you're on.
And so, given your role as the CEO of, one of the largest crypto exchanges in the world, you have obviously, as mentioned, an interesting vantage point into institutions. I'm sure you chat with them, but your team does as well. And before that, you were a large investor in Kraken. And so I'm curious as to what you're seeing directly talking to these institutions. We obviously know a lot of them. I mean, some of them are now in these DAT products. We see their names, come up. Some of them, we're doing the basis between CME and the ETF and, over time and things like that. Are a lot of these large, hedge funds, asset managers in spot crypto? Are you seeing flows, and how's that changing over time?
The amount of time it takes for anyone to get into crypto or even onboard into an exchange, it takes time, right? Like you have to learn the nuances of each, what I call venue. So Binance, Coinbase, Kraken, OKX, any of the decentralized exchanges, you have to kind of learn your way, crawl, walk, and run. And so I don't actually think it's as easy as someone saying we're going to go into crypto and then they move into it the next day. So I actually think that the best days, and this is not, doesn't seem like it's a wild prediction, are obviously ahead of us, in that every institution, every book, every prop trade, every traditional institution that is thinking about deploying capital into these markets, or even storing capital or savings or getting some sort of yield, is starting to think about how to do it and how to integrate and who to work with. And so it's not about, I wouldn't say it's about where we go from here. It's more about, can we continue to provide trust and services that we've already been providing in a what I'd say in a continuous way, and then continue to improve on that. So for example, we didn't do much custody with traditional institutions a year ago. Now the only customers that we have are traditional institutions. Like they're our number one customers. So I think that's the way to sort of think about it. And again, because we're an exchange in crypto that's vertically integrated, doing asset-based revenue, staking. We're also lending off of our balance sheet. We're also a principal. We're also an agent for so many different products. We're also letting people do spot plus margin trades. We're also doing futures. A lot of this comes down to where's the venue you trade from, where's the venue you explore from, and then where's the venue that you sort of do risk-based assessment on.
And so I want to pivot a little bit to U.S. regulation and policy. And so the Genius Act is obviously a major development in U.S. crypto policy. And how do you see it impacting both market structure and Kraken specifically?
So the piece that's really important is, how do people get access to trading assets? And then obviously the stablecoin bill that just passed, the Genius Act, was more about safety and security of what it means to have a stablecoin and who's going to be on that, right? And so now Tether's got some time to figure out how to get into the United States. Obviously USDC then becomes part of the ecosystem, and it's also what I'd say, all of these regulations will just give clarity to what I call market stability. Market structure, not just for us, is who's your regulator? Is it the SEC? Is it the CFTC? Is it a combination of the two, depending on which you're, from private token sale all the way to going public? I think at this point, depending on if there's a new bill sponsored from the Senate, or we take the Clarity Act bill for market structure from the House, it's really going to be, what are the rules of the road for someone who wants to start a token no matter where they are? Where's the venue they go to for raising capital? And then where's the venue and a set of venues that they go to in order to go public in some sense? And I think the interesting thing is, outside the United States, they've just basically said, hey, all this stuff is crypto and it's got a set of rails and just go. In the US, we're trying to figure out how to plug the gap between traditional financial products and what's going to happen in crypto. And so I'd say that there's some forward thinking there, but at the same time, it's kind of backwards in that it's kind of like the AI bills, right? Which is we can predict what the flop is going to be in the next 6 months, whereas every single week something changes, and then they're putting in sort of stopgaps for innovation. So my hope is, when we think about market structure, it gives the ability, not for the exchanges, because it's less restrictive for us. It's more about, how do you make it less restrictive for a protocol? May it be tokenized real world assets, a protocol, a utility, digital token, commodity, whatever it may be, to be able to have a path to be able to build their business, rather than think about what you need to do to talk to the SEC or CFTC. And that's kind of the goal, where you don't have to waste your time.
And so, Kraken is, obviously, the background with Jesse. Jesse is pro Bitcoin, pro freedom, and kind of had this, I guess for lack of a better word, kind of maverick personality to digital assets. And so, how do you balance, Kraken's commitment to compliance with the need to preserve some of those kind of core foundational, crypto values that I think Jesse kind of instilled in the company, like sovereignty and privacy?
Those cores are shared by everybody at the company. It's part of our culture. It's part of why I joined and why I invested in the first place as well. I'd actually say that, Jesse being a maverick is just essentially saying that we care about our, first 10 amendments, our Bill of Rights. It's just, core to what it means to be a U.S. citizen. So I think it's less about what does it mean from a regulatory perspective. It's just here's our culture. This is why we build Kraken the way we're building it today. Here's the set of products that we're building, including tokenized equities, here's why we launched X stocks to be 24/7 permissionless. Kraken doesn't need to own it. Like if you wanted to do it through a non-custodial wallet, we will. So it's more about how do we move all of our profit dollars and to continue to innovate and move the industry forward. That's what we care about the most. And so I'd say that like everything we're doing now is in line with that. And there's a set of products that we'll want to be in line with from a regulatory perspective. We totally get that. But then there's a large set of products that we're building where we're saying, okay, here's the mission of what we've been trying to achieve, from the past and what we're going to continue to do in the present and what we'll continue to build in the future. So the layer 2 that we contribute to is in line with that mission. What we're doing with X stocks is in line with that mission. And then what we've been doing by decentralizing pieces of what we do at Kraken into very specific, not just feature sets, but like venues of, I'd say, the intent for what you want to be able to do. Do you want to save? Do you want to store? Do you want to send? Do you want to trade? We think of those as different experiences, not embedded into one. I think the more embedded it is into one, the more centralized it is. The more centralized it is, the more you go head to head with the regulatory.
And so this is the section of this conversation I'm most excited for, which is public markets. And so how do you view the current state of the crypto IPO market, or the IPO market broadly, but particularly for fintech and crypto companies? And where do you think, is it a more favorable environment now? Kind of how have you seen it evolving? I mean, obviously there's the DAT side, but I'm kind of curious more on the non-DAT side.
The other hats that I wear are obviously on the capital allocation side at Tribe Capital, and so we do private investing, but we also do public investing in India specifically. And I think what's most interesting is that you have these market cyclicalities. I'm not the first one to talk about it, right? If you read any of Howard Marks' books, he talks about this, and he talks about like options value versus intrinsic value. Look, I think whenever you've got some sort of supply and demand, I'll try to dumb it down. Whenever you're in a place where you've got a lot of heat in a certain market, you tend to get a lot of FOMO and sort of fast followers in a category. So that might mean company number, let's copy company number 1, and let's have 50 companies. That might mean a treasury play. It might mean SPACs in the past. It might mean just using the word crypto. It might mean going in front of CNBC and saying the word crypto, and then all of a sudden you're a crypto company, just like you did in the past with .com or AI, machine learning, et cetera. And so I just think of this as like it's a part of the course, and you're going to have these highs and lows. And is this company actually compounding and doesn't have any fundamentals? That's what I care about more than anything. And so if you take a 3, 5, or 10-year outlook, any of these companies, if you were to ask Arjun, would you invest your own money into some of them? I'd say no, because it's a play on arbitrage. But that's how we think about it. That's how we think about my capital. And so one of the reasons why we invest, or how we think about our capital allocation strategies, even at Kraken, it's more about, are we compounding? Are we making money, cash in and cash out? Do we have a healthy margin? Are we growing efficiently, or are we just growing for the sake of it in terms of people or processes or tech? Or are we doing something that's going to be fundamentally, is there an actual return on our invested capital for the effort that we're putting in? And I do think, I don't know why this happens, but every fucking 2 years, someone is always just deploying capital in a certain area that just adds a lot of options value into something, but it's intrinsically not valued at anything.
And so, in your view, what makes a crypto native company attractive to public market investors, right? How do you differentiate and get people excited? Is it brand? Is it EBITDA? Is it revenue? Is it culture? Is it regulatory moat? What makes public companies, specifically in the crypto space, attractive?
I don't think. Again, this is my perspective in that. I mean, what's a crypto company? So, let's just put it back down to first principles. What do we do? Yes, we are growing off of crypto plumbing, technology, tokenization efforts, et cetera. But we're an exchange. So what are exchange type businesses look like? What do they need to look like? What's the margin that they need to have? The other vertically integrated products that we have that are asset-based revenue, those are traditional banking and financial services style revenue. And so you just need to make sure that they grow efficiently and frankly profitably in some cases where your return on invested capital is at a rate that's better than another investment asset. And so I think, yes, it can be exciting to say, great, you're in crypto, it's unbounded in theory. There's obviously a bounded cap for anything, but today, since it's new, the growth should be at a faster rate for the amount of capital that you're putting in. That's kind of how I think about it. And so putting on my analyst or investor hat on, it's like, are we growing at a compounded rate? Are we in an unbounded market? Do we have the ability to win? And are we putting our capital to good use in order to hit those milestones? And that's kind of the way in which you should think about what Kraken looks like today, what Kraken will look like in the future, and why we've been making some of the investments we've been making and some of the M&A targets that we've gone after or finished acquiring.
Yeah, I think that's totally a fair point, and I think that convergence is there. But I still think that, traditional investors don't necessarily understand crypto companies. And to give a practical example, I think Circle was trading at a higher market cap than Coinbase, even though Coinbase has the same revenue as Circle plus. And so how do you think about, educating traditional investors about what you guys do and how they should think about your business and the different lines and, how they should value it, either, as a public company, but also you guys have, been a private company that's raised a bunch of money as well?
I honestly think it just goes back to fundamentals, which is we're an exchange company. This is what we do. Here's what we do that's recurring. Here's what we do that's transactional. Here's what we do that's asset-based. And then it's up to you to decide how we think your value. I think what's interesting, again, about Circle, and I was there at the floor with the guys there too, is that most of Circle is retail, right? It's not institutional. Like, that's the thing that's been that held them up so high, and that's sort of put them at a certain equilibrium now. And like I said, this happens in every market cycle, depending on supply and demand dynamics, is that crypto is like a sexy term, so people get excited about it, just like they get excited about AI. And so, like when DeepSeek and the AI ecosystem came out, you saw a drop in NVIDIA, you saw a drop in Google, you saw a drop in everyone. That doesn't necessarily mean that DeepSeek is good or bad. It's just that there's a sentiment behind it, and so there's a certain amount of volatility behind that. So my job is literally just to build a business.
And so, obviously building the business, you have that you guys are building equities, trading. What are some of the most underappreciated trends that you're seeing in crypto right now?
I think the markets are, and how big they are, and the depth of that liquidity. I'd make the argument it's the deepest liquidity markets in the world, beyond anything, right? It's deeper than any of the CME futures books. It's deeper than NASDAQ or NYSE. So when you take that global market and demand for the types of assets that are going to come on chain, I just think that's going to change. Like, it's just going to change so much stuff in the ecosystem. And so we're talking about now, but when you I get really excited, and on the board of a bunch of other companies that are in the private ecosystem, including Carta. Just imagine, the $8 trillion just in venture capital that's locked up right now that can't do anything. Think about what happens with issuances, capital formation, and access to liquidity if the crypto markets start getting deeper and deeper into the conversions between public and private. The world changes very fast. This isn't something that's going to be 10 years away. This is most likely something that's 2 to 3 years away.
And you mentioned, right then, liquidity is really deep in crypto, but that liquidity is spread across, thousands of exchanges. And obviously there's been some consolidation, here, but where do you see volumes in crypto being 3 years from now, 5 years from now? Do you see them being concentrated in a few exchanges? Do you think a lot of that volume is on, retail platforms like a Robinhood? Where do you kind of see volume? Do you see consolidation, or do you think the market will continue to be spread?
I think it depends on how you define liquidity, right? And so, I would say that the global order book of the world is quite liquid, right? We are a venue into that liquidity as well, right? So when you think about, Kraken exchange has liquidity around a certain set of assets and pairs. But then you have the decentralized exchanges. Then you've got the other, we all work in tandem with each other. If you took a look at the pump.fun token sale, it was $500 million raised in 12 minutes. That was on our venue and on other venues as well. But we all coordinated with each other. It wasn't like we were competing. We were coordinating to make sure that's something that was successful. And that's something that's quite interesting, because then you're thinking about pulling in global liquidity for every asset that's there.
And so, my final question is actually more kind of putting your tribe capital hat on. One of the things that, venture investors have struggled with over the last few years is DPI. not just in crypto, but across the spectrum of venture funds. How do you kind of see that market evolving? Traditional venture funds, crypto native venture funds, but also private equity firms. With kind of the lack of DPI that we've had, how does that kind of impact the market and folks' ability to raise capital?
DPI is kind of a tricky thing. When the markets are down, everyone talks about DPI. When the markets are up, no one ever talks about it. And it's like I read all these blog posts and then I watch all these videos. The same people that talk about DPI now are the same folks that had raised like a ton of money and they had no returns. And so it's quite interesting. Look, long duration assets are long duration. Like that's the whole point. And there's a difference between short duration and medium duration. And so I'm not saying that you shouldn't be prudent and that you shouldn't figure out a way to make sure that you can return capital to your investors. It's that a different set of investors are investing literally for a very specific reason. So my pension fund or my sovereign wealth fund investors, if I took DPI in 2 years, they're never going to invest in my fund ever again. So it's a different set of customer bases that I have versus like someone who's high net worth or someone else who.
How do you think about managing that and the expectations there?
For like what?
For you have a family office, that put in, $10, and then you have a sovereign that put in, 50, and they have a totally different, horizon. How do you think about like managing that? And I'm also curious, is the family office a bit more naggy than the person who put in way more money, from your experience?
Yeah. Look, there are family offices out there that are like one of our largest investors is Coke, right? And it's across a multitude of their vehicles. They don't nag. They're extremely long term, right? They think about 30, 40, 50 years. Texas municipal retirement system, they think, they literally say, hey, like, talk to us in 25 years. So everyone's got a different horizon. I think what's more important is that if your intent was short-term arbitrage, companies are going to go public. I want to invest in this late-stage venture capital investment company, and then there was a market drawdown. You kind of have to wait. So of course, there's not going to be any DPI. And so you can either sell cents on the dollar, or you can wait till you get above a threshold, or if you were smart, you might dollar cost average into the good companies. And so what we did with our partners is that we just said, here's our top 10 companies that we think will continue to compound and grow. Here's where we think we should put in 50, 100, or 200 million in. And that's what we did. And so yes, the first initial price was low, second price was high, third price was low. You dollar cost average that out, then you can start thinking about what it means to make 3, 5, or 10x net. And I think most people don't think that way. They think very short term. And so I would just say, like, don't get into venture capital if you are expecting to get returns in 3 to 5 years. You have to wait 10 to 14 years.
Yeah, I think crypto folks that are doing liquid token investing maybe can learn a little bit from that.
Yeah,
they're investors. For sure.
like token investing into crypto is short-term horizon, which is, or at a certain point it was between 18 to 36 months. You could get your principal back plus more, and if you were lucky, you got more than that as well. And some folks made a lot, but it's the same thing. Like in our token fund, we have 2 different strategies. One is liquid, which is you get your capital very quickly, and then the private token sales is much larger. It's like 5 to 7 years.
All right. Well, thank you so much. This is amazing. We're honored to have you here. Come by the event, and thank you everyone for listening. So, quick reminder: we have a happy hour now, starting at 5. It's going to be, if you walk outside past the food trucks, there's kind of a garden there. There'll be a bar. The happy hour is there, starting at 5. We'll have dinner back here at 6, sponsored by Reserve One. So thank you to Reserve One for sponsoring, and then networking after. So thank you, everyone. Thanks for joining, and thank you, Arjun.